Leading our bulletin this hour, the South African Reserve Bank has cut the repo rate by 25 basis points to 8%. It's the first cut since the COVID-19 pandemic 4.5 years ago. Reserve Bank Governor Lesedi Kganyago revealed the decision following the Monetary Policy Committee meeting in Pretoria.
The MPC decided to reduce the policy rate by 25 basis points to 8% per annum with effect from the 20th of September. In discussing the stance, MPC members considered an unchanged stance, a 25 basis point cut, and a 50 basis point cut. The MPC ultimately reached consensus on 25 basis points, agreeing that a less restrictive stance was consistent with sustainably lower inflation over the medium term.
All right, now joining us for more on the repo rate cut is Chief Economist at Pan-African Investment and Research Services, Dr. Iraj Abedian. Good evening, Doctor. Thank you very much for joining us on the program. So finally, we've entered the cutting cycle that many have been talking about, but of course, some conservative commentators had said we'd see our first cut perhaps early next year, but here we are. Your reaction?
Yeah, I think it's finally, as you said, good news. Long awaited by consumers, not just in South Africa, but globally. As you would know, yesterday the Federal Reserve, after 4 years, cut the rates far more aggressively, by the way, than our South African Reserve Bank. But I assume that for the next 2 years, we're going to have successive cuts of 25 basis points, as I read the Reserve Bank wanting to play it safe. But all in all, it's good news. Not only our exchange rate is strengthening, inflation coming down, interest rates coming down steadily. These are all a combination of what this economy desperately needs.
So you're saying that what we saw take place with a number of central banks cutting theirs, that beyond that, also our sustained moderation in inflation over the last few months probably were the real factors?
Absolutely. Of course, different countries have different situations. The United States has a different condition than we have. Japan is the only one that's going the other way. But other than Japan, all other central bankers in the next, I think, 18 to 24 months are likely to be on a reducing cycle of interest rates in a coordinated way, with some minor differences. America at the moment is a lot more aggressive. Our Reserve Bank is a lot more prudent.
Speaking of that prudence, when listening to the governor, it seems the policy position remains very tight. They'll still act with great caution, even though global conditions have become somewhat favorable, if you will. Your views on just that prudence?
I think that the Reserve Bank obviously is worried about some of our structural issues. For example, our currency is open to volatility. There are geopolitical changes globally that could cause volatility and push our interest rate, our imported prices higher. All of that can really suddenly reverse our inflation dynamics. At the same time, our government finances are not in a good shape. Government is over indebted. That can cause balance of payments, potential volatility. So the Reserve Bank prefers to keep a steady hand, reduce interest rates, but watch what happens to our exchange rate and to our inflationary dynamics. And I'm sure they would love to see stability in our inflationary dynamics and prices, and then cut the rates. For example, one of the things that they have to watch very carefully is the price of energy, the price of electricity, which could have very, very huge impact on the pattern of price improvements. And more broadly, Mpondo, is the Reserve Bank is concerned about administrative prices, what municipalities do, what government agencies do. All of those have to be watched very carefully to make sure that inflation doesn't bounce back again.
Do the geopolitics or the geopolitical developments pose a serious threat? Because you also touched on that specific aspect, especially because right now the war is raging on in the Middle East. Lebanon's Hezbollah is now under serious attack with the pager explosions that we keep reporting on. So this unpredictable geopolitical environment is said by some to pose a serious risk to inflationary shocks. Is this honestly the case?
Absolutely. Just let's take a negative prospect. If this Middle East situation get out of control, Red Sea can get blocked. That's about 40 to 45% of daily flow of global oil that will be stopped. Even if it stops for 2, 3, 4 weeks, we could have huge impact on that type of global geopolitical, and immediately translating to price increases, exchange rate reacting. And there isn't really anybody in control in the global environment, geopolitically speaking. So when geopolitical conditions are so tense, not just in the Middle East, but also in Europe, Russia, Ukraine, EU is not a happy environment at the moment. Southeast Asia, North Korea, South Korea, China, United States, Taiwan, these are all like a time bomb that could explode all of a sudden and cause this disruption in the global financial situation, and then inflation could get out of hand again very quickly.
And I suppose it is important to have these kind of conversations, because some other people would probably think, why are we constantly monitoring what's happening with Hezbollah and Israel currently, and why there seems to be this intense air of many people who are on edge. I mean, we had the UN's Antonio Guterres also warning against what could possibly become an escalation of tensions in the broader Middle East. But it seems everything is linked, because as you say, we're equally in a very precarious position as a country, that if we see any escalation of tensions there with Hezbollah and Israel now, it could then lead to those restrictions in supply. And then we have to see perhaps increases all over again.
Absolutely. The fact is that the interdependence of nations, economically, financially, and geopolitically, is a reality that we cannot deny. There is nobody who can say, well, I don't care about Middle East, or I don't care about China, or what I care about Russia. We have to care. Unfortunately, global governance, the United Nations, is not in a position to govern the new tensions, and therefore there is this fragile conditions that can go either way, and the reserve banks are the only anchor for the global economy at the moment, so they're playing it very safe. As a country, we have to take care, and we have to be watchful the positive roles that South Africa can play in some of these tensions, but it's not a lot of power, but we have to worry and we have to be concerned about it.
And then just in closing on the growth front, it seems the Reserve Bank is quite optimistic, saying because of what we've seen with the stabilizing of electricity, that possibly we're going to see better growth.
I think that there is definitely cause and reasons for optimism. We have now stability in our electricity supply. We have also consumer expectation. All the early indicators suggest that consumers are becoming a little bit more optimistic, and definitely the business community. So I think there is reason to be optimistic, but we need to also remain steady in dealing with some of our structural economy on the policy side.
All right. We also heard him touch on the two-pot. It seems that with everybody going to withdraw, we're going to see a lot of money circulating, so the retail industry will get some sort of a boost there. Do you believe that's the case?
In the short term, there will be a short-term party for the retailers, but we have to be very careful on that front so that we don't just rely on that. But yes, that's also a bit of good news in the short term.
All right, Doctor, thank you very much for your insights this afternoon. That's Dr. Iraj Abedian, Chief Economist at Pan African Investment and Research Services.